All right. Good morning, everyone. We'll just give it some minutes to 10 before we start. Good morning for everyone who joined the call early enough. I can see the speakers are here already. Lydia, Joyce, Esther, Essay, um, Noah will join us at 11. 10 o'clock is quite early for her, so she will join us. Coyote as well will join soon. And then some of the other guys will join us. Some of the founders and investors will join us while we start the presentation. Like I mentioned in the chat, there's a flow of agenda just to take us through what we'll be doing. It will start with the welcome speech from me, which I think I'm already doing partly on that already. After that, we'll have a quick rundown of what we've done in 2025 as Umbrella Saturday. Just a very brief presentation and then a peep into what we plan to do in 2026, just in case we have some partners here. And shortly after that, we would have Joyce from Russell Bedford, JKLC, Nigeria, give us a presentation on the outlook, which opens up the conversations while I just do the introduction to our speakers. And then the conversations move into 2026 market outlook for startups, and then we close the chapter with Q&A. We like to start very early at Umbrella Saturday. We've never had the situation where we waited past 10, so I would like to keep that culture. My name is Ayoola Ogunyomi, co-founder and CEO of Umbrella. And Umbrella is Africa's marketplace for startup investment and exit. I want to welcome you into a new year. I know we've done January already, so saying it's a new year, but it's a new year for us at Umbrella Saturday because this is the first edition in January. We started this May 2025, and it was an amazing session. We had 21 sessions all through to November, and every Saturday we always showed up for founders, for investors, for partners. And if you're joining us live, I just want to thank you for making our time. And also, if you're going to be watching this later, because it's always recorded and uploaded on YouTube, just know that these conversations are better live, and because of the context, the nuances, and the timing also matters. I just jump briefly into my presentation. Like I said, we like to do it very fast at Umbrella Saturday. So 2025 edition at Umbrella Saturday was very interesting. We had 21 curated session, which we started around May and then ended in November. We understood that the culture of Africans in December would not allow us have those conversations that were deep. So what we tried to do is not to have those conversations in December. We convened founders, investors, operators, ecosystem stakeholders, put them in the room, had deeper conversations. Each episode attracted at least an average of 30 to 40 people at intervals. And then in total, our database ran into like 500 founders, investors, advisors, and ecosystem players. Basically, we tried to look at some very detailed conversation, and it was like for us a deliberate effort to help founders grow from ideation to scale. We started with books to box, and then ended it with risks to resilience, which was a very interesting session. All sessions are uploaded on our YouTube page. I'll skip this. These are just some of the speakers that have come on the platform. From May, when we started, we had 3 people coming, and then we moved all the way to June, where we had 4 panel sessions or 4 speakers engagements. In July, we had 4 again. Very interesting guys spoke around funding, and shared their own story. Particularly for me, the most interesting among it all was from float to flow, and then of course from Lagos to Toronto, where a founder exited and became a VC. We moved to August with very interesting conversations as well. We tried to switch the conversations from just basic conversations for founders around fundraising, startup, and the rest of it. A lot of founders do not know how to manage changing their careers. For some people, they started working out somewhere and then they found themselves into entrepreneurship. And for some people, entrepreneurship sounded like a new journey, a new career journey. So we had someone give a very enlightening conversation on that, Mr. Shola Oshinoiki, someone who I also respect very well in the industry. And it was very interesting conversations as well. In September, it was very amazing as well. We had the founder come tell us how to scale in Africa, Adaku Ekweme. Some very interesting conversations around how to sift between hypes, and then find substance from a VC lens, which of course Benjamin Udoku took us through that. And then, of course, how to, identify blind spots. It went deeper in October, which is the month where Umbrella turned 3. As a business, but we had very interesting speakers as well. One particular for me was Opemipo Dada as well, who was able to take us from informal to investable, just speaking around how the informal market is also an opportunity for investment. And then we closed the session with my 2 amazing speakers, Angela Koki, and then of course Christine Wilson, who did justice to it. Particularly for me was Christine's session where she pivoted from English to French. Just because we had, some guys from the Francophone country, and then she did the interpretation back to English for us. So it was particularly very interesting, and I'm looking forward to getting more of such sessions where we even go into the Portuguese speaking country, and also have some speakers from there, and myself also speaking a bit of that lingua over there as well. So I'm learning a bit of it, and that's part of my training this year. I'll just quickly take you through a deep dive into what we plan for 2026 at Umbrella. The entire year for us is titled From Signal to Scale, because for us as well, we want to scale as a business. And that's why we're also looking for the right set of partners, right set of investors, right set of founders who are also identifying signals and then are also scaling. Of course, in January, which is this session we're looking at, the signal itself is very important, which is the outlook. Where are these opportunities forming from in Africa? And then we move into February, where we have a lot of founders come tell their stories, the stories that you don't hear, the journey behind the growth. In March, we would have a look at the market, where we would have some investors pitching process happen. We have the pitch and pair, which was a session that we initiated last year. But again, due to some challenges that we had, we didn't really go deeper into it as a business, but we want to do that to end the Q1 edition of the Umbrella Saturday. In April, we have the operators, where we'll be bringing a lot of operators, just trying to speak to us around finding the signal in the noise. There's a lot of noise in the startup ecosystem in Africa, and I know a couple of us would agree with me. A lot of noise, a lot of founders noise, a lot of media noise, a lot of startup failure noise as well. So we need to tell the story from the operator's lens. The conversations as well, just having those conversations. We were thinking of doing an AMA, which of course will happen in May, where we have founders and investors just speak to each other. It's the African edition for us, and we're speaking to audience around the early stage to growth stage founders across Africa. And then in June, we have the capital stack, where we'd have LPs and GPs, come speak. Luckily for us, we have a couple of partners on that conversations already. So we're looking forward to how successful that would be. The foundation, which is also very important, because in July, we'll be looking at how capital really moves in Africa. And I'm sure that we'll be seeing a lot of it already. We're seeing some acquisition within the African market. Recently the Flutter Mono story. We also emphasize that the market will see some inbreed acquisition. In August, we'll be looking at the product itself, building for Africa, product distribution and retention, which is also very important in conversation for us. What kind of product is Africa looking to build? Are we just building for Africa, or we're building for the world as well? And then in September, market expansion, just scaling across borders. In October, growth capital, which of course is our anniversary special. October is the month where we will be 4 as a business. So we'll be doing another pitch and pair session then. And then in November, the survival playbook, how to survive, downturns, pivot, and then hard reset, hitting the hard button. And then in December, just a review of the signal, where this same set of panels who would be speaking today would come back and tell us the review of their signals. that they see. We want to thank all our partners, Russell Bedford, JKLC Nigeria, for joining us in this journey. Joyce is on this call. She represents the business as a partner. Tech Pression, and then, of course, Plan B Insurance for women. A couple of other partners have also come on board. We just want to welcome anybody who is willing to be a partner with us on this journey. For us, we believe that the foundation matters more, and we need to build a solid foundations for founders. What makes us different? We're community-based. We are a verified pipeline. So we go through the end-to-end from investment readiness, due diligence process for founders. And then we have a multi-stakeholder experience that we bring to the party, where it's a lot of learning, it's a lot of networking, it's a lot of matchmaking, all done within a platform. We like to say that we're not just another webinar. We are Africa's most reliable digital gateway for early startup deal sourcing, expert insight, and of course, startup investments matching. I welcome you again to Umbrella Saturday, where we would be speaking into a lot of it. I will allow Joyce pull up a screen now so she can take us into the outlook for 2026, the market outlook for 2026. Joyce, you can just do some introduction of yourself. I would still ask you to do an introduction again when you're speaking, but yeah, just do a bit of introduction around the Russell Bedford's JKLC Nigeria partnership, and then of course the business itself, and then you can just take us through the outlook. Thank you very much.
Okay, so first of all, thank you all. Nice to be here. My name is Joyce Bassey. I'm partner at Russell Bedford JKLC Nigeria. We are a professional services firm located in Nigeria, Lagos, of course, and part of a 350 member firm in 110 countries globally. So I'm here this morning. Morning my time. Yeah, it's still morning. Yeah. So I'm here this morning to talk about the Signal 2026 market outlook, where Africa's opportunities are forming. So stay with me for another 10 to 12 minutes and we'll discuss about this. So first of all, we are looking at the realities on ground. What do we expect for 2026? This is going to be hinged on 4 key areas. First, we have the market. What is the market expected to be? Well, the predictions are that investors will be looking out for profits over growth. So it's no longer the story, how well is this company growing, or how well is this founder growing? The narrative would be how much of that growth is actual profits. And why? Because we've seen growth that have collapsed. So investors will be interested in companies that have a clear profits path, and definitely investments will be a lot of local investments. DFIs and cheap funding will no longer be as accessible as it was. Then the markets will be looking for digital businesses that are practical. Okay, so we've looked at, in the last few years, we've all experienced that a lot of companies are becoming tech savvy. They're looking at how to make their businesses more practical, especially with the prevalence of AI, TikTok, and many other businesses. We've seen their exponential growth. So that tangential is going to be the narrative for 2026. A lot of talents will be young. So we want to capture that, even though it's very difficult to retain them. We still have to look at them because that is where the markets will be trending. And then we're looking at infrastructure, right? There's going to be more room for resilience, as there's going to be opportunity that is going to keep growing. Sustainability is going to be important. Local manufacturing will keep on the rise as people begin to dump imported goods. And we're already seeing that, right? Especially with what is happening in the US. Right now, a lot of people are looking to grow what they have inwards. So that creates immense opportunity for founders. Then regulation is going to be very important. Compliance is called. No more hiding space where you're going to say, let me run my business and hide. We already see that's happening in Nigeria. The tax system has been overhauled and things are going to be clearer. So how to navigate bureaucracy will be a key skill for founders who want to survive going from 2026 and beyond. So in other words, the reality check for investors would be, for both founders and investors would be, What is my business about? The key factor would be that businesses who are able to solve problems, who are able to operate lean, design for chaos, and think long term, not quick exits, will definitely be the ones that would hold forth. So we all know that Nigeria plays a central role in West Africa, of course, but then is your business prepared to succeed? Because definitely Africa has opportunities, but then the market will be tougher, the stakes will be higher. So only investors who know how to play the game or who know how to watch the signal will continue to succeed. Running a business is not just about setting it up. We have to look for where the opportunities are forming, right? If we want to be part of the narrative as business owners, and where would the opportunities be forming? The financial services infrastructure has always been the mainstay in Africa. It will continue to be that. Renewable energy opportunities keep growing. It's been on the rise and it will continue to grow because we know that power is still a major problem in Africa. AI and driven businesses already growing will still continue to grow, not just in Africa, globally. Agriculture and food systems is important because we all need to eat. Healthcare access, because people are now more interested in their personal health and welfare. Trade and logistics will continue to grow because then is the bridging gap, because it bridges the gap between demand and supply. And affordable housing and real estate will continue to be important. So the question is, why are there opportunities in these sectors? Is it because they are trending? Of course not. It's because they solve essential problems. So we need to look inwards as business owners, as founders. Is my business solving a problem in the immediate, short, or long term? Definitely, this is very key. So, what has changed, like in the last few years and 2026 and beyond? First of all, the mindsets. So, if we look at 2024, 2025, or even beyond that, we remember there was COVID. COVID opened up a lot of opportunities and opened our eyes to a lot of possibilities as well. And then businesses are now rewarded for their growth, right? And user numbers. There's a lot of data available, unlike in the past where there was a lot of assumptions. Now there's data. You can access data at any point in time. So with this information, people are making better decisions. And investors are also asking targeted questions like, how does this business make money? Can it survive without constant funding? Are controls and governance in place? Right? So ultimately, this means that growth without structure is a red flag. As a business, you're growing, you have to make sure you have structure. You have to constantly ask yourselves questions about your place in your industry and in the business ecosystem. So in as much as everybody wants to grow, everybody wants to stay in the long term in business, some businesses still go out of the space. Why? Because of major impediments. And what are some of them? First, poor or non-existent business plans. You have some people, they're either copying somebody's business and halfway down the lane, they are gone. They don't know what else to do, or they just have the business in their head. So poor or non-existent business plans can be a major impediment because a business plan gives the picture, it gives a pathway for the business survival. Now, some even have the business plans, but their financial models and projections do not match reality, right? Some believe, let's just juggle figures, but those figures need to be real. They need to match reality for it to make sense in the first place. Some companies struggle with bookkeeping and accounting practices. Well, in our space, we've come across businesses who think that accounting is just for you to be able to submit audited accounts. And such kind of businesses always get in trouble because your accounting practices are very key. They keep the numbers that translates to the real money. So it's a place to pay attention to. Some businesses struggle with financial controls, right? There are no proper procedures in place. The system of control within the company, from operations to financials, are totally weak, and this give room for problems and fraud, possibly, ultimately leading to business downturn. Then non-compliance with regulations, or even handling those compliance too late, could lead to problem. We've heard of companies that get closed down because of tax evasion, or they're not keeping their financials, or are not submitting their statutory requirements. We do not want to fall into such category. And then another core area that people tend to miss is the poor governance structures. When a business does not have proper direction, some companies do not even have board of directors. Maybe it's a one-man business, and once the idea of that one man is gone, the business also collapses. So poor governance structure is another source to business downturn. Now, when we put all these problems together in one place, or even have one within the business, it could lead to gaps or delays in funding. So such founders would find it very difficult to raise money. They increase risk in their business, and sometimes they completely do not grow, and of course end up turning out of business. So for 2026 founder mindsets, we need to focus on three areas. One, build for sustainability, not appearances. So it's not about how big your office looks, or how corporate you are, or how much appearances you make in the business space. You need to show up with your figures making sense, right? You must be able to make sustainable revenue and be able to continue to grow it. You have to treat finance as a growth tool. No more like, oh, we are coming here to do audits. Oh, the tax people are coming around. No, your financials should be your decision-making engine, right? And founders need to begin to understand the numbers. It's not, oh, I don't like figures. Just tell me. It should stop. As founders, I remember there's a course in LBS. I don't know whether they're still doing it. Let's look for how to train ourselves to be able to understand numbers, because if you pay attention to numbers, they always tell you what is happening in the business. And finally, we need to prepare for investment before we need it. Some people come to us and say, we need money. And then you look at the system, you can't even help them so much, because they have to go back to the drawing board, because they haven't been maintaining their books. They haven't been keeping their house clean. Housekeeping needs to be done, and you start from today, not when you need the funding, because we are going to ask for historical information 3, 4, 5 years down the line, and it's going to be difficult if those were not being done. So investment readiness is a process, not an event. So strategy without a right mindset will definitely fail. So you must have a right mindset as a founder to be able to grow. How do we help at Russell Bedford? We want to let the founders here know that at Russell Bedford, we work hand in hand with founders to support them in writing their business plans and strategy, in helping them raise funds for their business, and for investors in helping them identify investable products or companies. We also provide audits and regulatory compliance, tax compliance and advisory services, financial reporting and accounting clarity, risk management, corporate governance, and advisory. Now, if you pay attention to all of these serve to help businesses prevent or avoid the impediments that I had mentioned earlier. So overall, Russell Bedford JKLC Nigeria, we support founders to grow and speak the language that investors understand. So that is very key. You must learn how to speak the language that investors understand, so that your business can be investable. So ultimately, what are the key takeaways here? First of all, it lets us know that 2026 is not coming here to play. It rewards businesses that are prepared, that are transparent, and are disciplined, both financially and in their operations. Founders who build structured businesses will definitely find capital, and those who chase hype will struggle. That is a fact. So 2026 is not about chasing hype. No, it's not about trying to be on TikTok or be on social media or be the most trending company. Rather, it means optimizing the right signal,
Mm,
build real value,
mm,
know your numbers. It's not just the accountant. As the business owner, you need to understand the meaning behind the figures.
mm,
Take your governance seriously. Surround yourself with the right partners. If you're in the room, look around you, right? Make sure you're moving with businesses that would support you. Founders who optimize the right signal will not just survive 2026, they'll definitely define the next decade of Africa's growth. And I'm sure that's where all founders want to be, right?
mm.
So at this point, I will say thank you
Thank you.
and I will bow out. Thank
Thank
you
you
very
very much.
much.
Thank you very much, Joyce, for this wonderful presentation. As we enter 2026, one thing is very clear. Africa's startup and investment landscape is no longer operating at a momentum. It is now operating on intentionality, and that's what I see in what you've said. Over the last few years, we've seen capital become more selective, not, absent, to be very honest. Investors prioritize governance, structure, and real economics, which is what Joyce has said in this conversation today. Founders are forced to move from storytelling to execution. So it's no longer the time when you tell the stories. Investors are more concerned about the execution, the story behind the numbers. And what's interesting is that while the global narrative are often frame Africa's, investment landscape as one which is slowing down, the reality is that on ground that we see at Umbrella is that deals are still happening,
Yeah.
companies are still scaling, and then the best rule of the game or the best thing is that the rule of the game has also changed. Gone are the days when you use your pitch deck, which was storytelling. Now your numbers are what investors are more concerned about. Gone are the days where you quote your TAM, your SAM, and your sum. Investors are asking you actual numbers, around there. So in 2026, what we see on our own end is that access to capital will be more strategic than cynical. Opportunity is forming earlier than we think, and these opportunities are forming than most people even realize. And that's why we're having this conversation. And then the gap between the informed builders and reactive builders is widening. Before we used to have reactive founders, but now we have informed, founders building scalable companies. And this is why this conversation really matters today. The next session, where we're jumping into where I would introduce our speakers, to unpack this entire conversation around the market outlook. We have brought together a group of leaders who see Africa's market from a different lens. But of course, complementary angles, which helps to complement the conversation that we're having around Africa today. I will introduce each speakers briefly, but I would also give them a minute or two to tell us about themselves, what they have done, who they are, and then what their perspective or what perspective they bring to this conversation today. First of all, join me in welcoming Nida Oga. Good morning.
Thank you. Thank you so much for having me on your platform. Thank you, Joyce, for the presentation as well. Very helpful, very insightful. My name is Lydia Oga. I work as so my former designation, which I had sent to Ayoola, was client coverage and partnerships. That has been slightly tweaked,
That's
you know.
upgraded.
So, well, it's around deal origination and partnerships for the Southwest region of Nigeria. So yes, I basically work with Emerging Africa Group. It's an investment banking firm, financial service sector, and we actually look at, or we have subsidiaries that covers the financial key sectors like advisory, asset management, trustee, microfinance banks, and a fintech. So personally, I am the founder of Finance Talks with Lydia, where I empower people on financial management and how to, yes, plan their finances better. So I look forward to having this conversation because startups, founders, even individuals, retail investors, HNIs, corporate organizations are people that I liaise with on a day-to-day. So yes, I look forward to just sharing my knowledge and also hearing from others. Thank you so much.
Thank you, Lydia. Up next, I have Kayode Omo Shebi. Please correct me if I'm right or wrong with your surname. Hi, Kayode. How you doing? Kayode, the
Yeah,
big
I'm
man.
good. Pretty good.
Good to have
Hi,
you. Yeah.
thank you so much, and thank you for the invitation. It's good to be on the call. I mean, it's the right timing for everyone to see and hear and share ideas about where we think the markets and the economy is moving this year. So, just quick introduction. My name is Kayode Omoshibi, and what I do is I structure deals, I unlock capital, and I enable businesses. So, from the capital market side to the funder side, and also then supporting businesses to scale. And I do that from two angles or two umbrellas. There's World Bridge Capital Partners, where I direct investment banking, and then also have More Africa, where I do research and strategy and advisory for governments, subnationals, municipals, and also for businesses. Thank you.
Thank you very much, Kayode. I think for me, it's the fact that you do it from two umbrellas. So that's the only thing I take out from that conversation. All right, thank you very much, Kayode. Up next is Esther Otunsoya. Esther is a fantastic woman that Endeavor has taken into consideration. Hi, Esther. Are you on this call? Titi is
Yes, I'm here.
Titi is a very close friend. I'm sure she would have been excited about this conversation.
Hi, everyone. I'm so glad to be here. My name is Esther Otusanya, and I work with Endeavor. At Endeavor, I select and support high growth startups, high growth companies, like I like to call them, not startups. So basically, I do investment research, sourcing, diligence, and also portfolio support across West Africa. I'm able to support these companies with expansion, access to capital, access to market, and access to network. Basically, I sit in the middle of strategy and numbers, so helping these founders think through traction on financial projection and also their key metrics. So I'm hoping I'm able to contribute a lot to this conversation today, and I'm glad to meet everyone.
All right, thank you very much, Esther. The custodian, are you in the building? S.A. Gibroma. I hope
Yes, Mr. Juboma.
Gibroma. All right, thank you very much. Hi, S.A. How you doing? Good to have you here.
Yes, good morning, Ayoola. Good morning, everyone.
The custodian.
Good morning, everyone. I am S.A. Broma. I am a strategic operator. I serve as the intersection between founders, investors, and technical partners. Why I say I'm strategic is because I'm focused on the secondary cities, right? And we have an ESO, an enterprise support organization that I co-founded with two other strategic partners. And we're focused on building and supporting startups and SMEs in the Niger Delta region. So we're not looking at the Nigerian or the African market. That's a very big market. So we are niched down to a region, the Niger Delta region, where we are focused on building and supporting startups that are focused on key industries like the climate tech industry, the energy space, right? And also the agtech space, like building solutions that actually solve the wicked problems that exist in that region. And moving on to that, we are currently also launching our fund. It's called the Delta First Fund. And that fund is to support founders that are building solutions, energy tech solutions that will solve, the carbon emission problems in the oil and gas region, and also founders that would build B2B SaaS solutions that would improve the efficiency of the upstream, the midstream, and the downstream sector in the oil and gas, region, which is the Niger Delta region in Nigeria. And I look forward to having more productive conversations and learning from the other speakers, and also answering questions that will shape, the African market outlook for 2026. Thank you very much.
Thank you very much, S.A. So I've just let Joyce do our introduction. I don't know if Nora is here already. I don't think so. She said she'll be joining by 11. It's not at 11. But when she comes in, I'll do an introduction for her. So, hi, Joyce. Let's have your very brief introduction. You already took us through the outlook.
Thank you once again for having me, and nice to meet all the other speakers. My name again is Joyce Bassey. I'm a partner at Russell Bedford JKLC Nigeria. We're our office is in Lagos, right? But we're a member firm of an international firm, Russell Bedford International. We're in 350 offices across 110 companies. So we provide professional services from audit, supporting businesses from conception to ideation and through growth, and unfortunately sometimes through exits, which we never planned for anyways. So here we are supporting businesses. Thank you for
Thank
having
you
me.
very much. Thank you all for being here. So let's go into it. I will start with the big picture question to help us get grounded. So for all speakers, you're going to be answering this question, which is like what I call the big picture question. So before we get into sectors and capital, I want us to just have that ground knowledge from your seats, from the seats that you all sit. You're all at the intersection. I hear the intersection, the umbrella, the man who is raising the funds now in the Niger Delta, the people who are giving support to founders. From your seat, what has fundamentally changed about Africa's opportunities landscape going into 2026, compared it to the last 3 to 5 years? So what has changed? Let's go with Lydia. You go first. What has changed?
So I will say that the Africa that we see now, 2025, is not the same, from years back. And back then, I think that we're more in that promise and excitement phase where everyone was just talking about the fact that there are a lot of opportunities here. Talking about the fact that we have fast growing markets and we have a huge potential to, of course, innovate. And to be honest, that is still true. So we have seen people who skip traditional banking into fintech apps, or seeing small businesses just operate fully on social media and doing really great. We've seen markets gone digital, and what then happened was that money started moving a lot faster than the businesses were actually ready for. So there is capital, but then it was based on the ideas. It was based on the fact that, oh, this looks very good on paper. And because of that, of course, these companies were beginning to scale quickly, but then there was just no sustainability. With the funding resets, currency volatility in places like Nigeria, in Ghana, with the FX constraints, with I would say higher global interest rate as well. Investors are now beginning to look for, rather than, oh, is Africa interesting, which we know that yes, there are potentials here. Africa is a great place to invest in. Investors are now looking at which businesses can actually survive volatility, which businesses can actually manage their risks better, which businesses can actually improve on their revenue and also increase their profitability. And I think that shift, it's actually healthy. So Africa investors are beginning to look at companies and with better structure. That's what I'd say.
Thank you very much. Kayode, what twist would you take to this direction that Lydia has put on the table?
Okay, so what I think has changed, to add to what the good thing Lydia said, is first of all, stability. So we haven't been stable since 2019 as a continent, right? From COVID, if you look at Nigeria, went to the Russia-Ukraine energy prices, crash cost policy, deregulation, FX. From Kenya, you had finance bill, tax laws. So there's been a lot of volatility. We've just had the first 12 months of stability, really. And if you look at it from a business standpoint, there's an expansion. Like businesses are now looking to expand. If you go to the oil and gas sector, drilling activities are scaling in numbers. People are looking to grow their plant lines, their production lines, healthcare, education. So that's changed. Secondly, is we now have a stronger inside and outside population, which I mean the middle market. So what has changed in the last 5 years is there's a big Nigeria and diaspora market that is also supporting the African diaspora market that is supporting Africa from a consumption and a remittance angle. So it's becoming a big part of the GDP of Africa itself. And that's why, for example, you can see an artist like a Burna Boy that can sell a 5,000, 10,000 across different cities in the world without, and they're all blacks, right? So you have a big GDP from that. So that alone has sort of expanded the African economy, right, by maybe 30, 20% or 40%. The other part is that policies are beginning to become more private sector led. So if you start from South Africa to Nigeria, you just realize that the private sectors are becoming more formalized and institutionalized and unlocking the right capital. So any sector you see that has grown so far in the last couple of years, it's either there's been a deregulation or a sort of tacit privatization that is happening. So those three alone is beginning to change the dynamics across different supply chain and value chain, from consumption to trade to extractive industry. So I think that what we just have recently is like the continent has evolved, even though it's been opaque across different regions, but it has evolved from what it was pre-2019. So we've actually survived COVID, and we just come out 5 years and there's stability, and people are now looking at the real sector, which is beginning to scale. Thank you.
Interesting perspective, Kayode. And I find this very interesting because some of the use cases or use case of your conversation, sounds very interesting. Entertainment is not something that you really find a lot of investment people speak to, but you were able to even speak to that around Burna Boy and then the capital growth around the diaspora. I find that very interesting. I think we would have a conversation just after this around, funding for the entertainment industry in Africa as well. Esther, let me hear your perspective.
Okay. Already interesting perspective I've heard from the previous speakers. I'll just add to that. I think the biggest for me would be that opportunity in Africa is becoming more real economy. I mean, the biggest value is being created in businesses that are actually solving fundamental issues. So when we are looking at scale, we can already see that these companies are actually scaling faster, are working around energy reliability, healthcare, and these are not optional anymore. And we can already see that happen from the acceleration on these companies. Also, we are seeing more diverse source of capital. 3 years ago, most founders or most businesses, startups are looking to raise just equity rounds, but now there is more debt, structured financing, even partnerships, a lot of partnerships. The ecosystem is actually riding a lot of partnerships right now. And this means that not all businesses will thrive on equity. And we can see that founders are beginning to actually understand that to actually not have a mismatch in their capital and their business model. So it has to actually match. And founders are already realizing this, that when you match capital to your model, it actually, the business scales faster. And something else that is changing in the market is the market is no longer, I think Joyce also mentioned this, the market doesn't feel like a story market anymore. It's more like a performance market now. You have to show not just traction, you have to show profit over growth. So performance are not just stories. A few years ago, founders could raise money largely on narratives or just on the market size or a compelling pitch. But now investors are excited about the opportunity of real value. And what is value to shareholders? Value to shareholders is when you're able to bring profits. Growth is not just value, it has to actually maximize profit for the shareholders. So investors are excited about this and they want proof of execution. So not just growth, like Joyce mentioned. So I think these are the things that I'll say are changed, fundamentally changed, like over the last 3 to 5 years.
Esther, let's hear your view. Thanks, Esther, for that very great insight. Let's hear your view, Esther.
Thank you very much. I was not able to turn on my camera during the introduction, so here am I. Okay, so simply, I'll break it down into three. So the market has moved from vibes to clarity, right? It has moved from shiny pitch decks to customer reviews. It has moved from wait list, right? It's moved from wait list to customer funded growth. So it's no longer business as usual, right? When the startup boom started, fintech was the first, and everyone started building, look-alike fintech products, and just felt, okay, if we're building something in the fintech space, we're definitely going to raise funds, right? Some of them got lucky, but the tides have changed. Now the tides have changed. Then the international investors, they were carried away by storytelling, right? So they loved the story, they loved the folktale. So founders were able to, put together and craft those stories and just tell you, I'm building something to democratize, right? to bank the unbanked, to serve the underserved. And the investors were like, oh wow.
Now I'm integrating AI.
And when they were not able to return the monies to their LPs, now they knew that this is not business as usual. So if you saw what happened last year, there were a lot. Nigeria had the lowest among the big four. We had about 390 something million. South Africa did about 1.2. Kenya did about 1.1. The point, what happened was that Nigeria did more volume, so we had a higher volume of deals, right? But we had lesser funding. And if you look at the industries, yes, fintech. Nigeria is gradually becoming, let's say Lagos is gradually becoming like the fintech capital of Africa. But if you look at the next shift, we moved into climate tech, energy, and mobility, right? That tells you that funding is coming to sectors that are building to solve real problems, right? Look at Nigeria. Nigeria is an oil and gas rich state, right? Nigeria has a gas reserve of over 219 trillion cubic feet, right? Associated and non-associated gas. Now the world is looking at natural gas, looking at the industrialization. We're talking about AI. We're talking about building tech solutions and whatnot. All of this have to thrive on infrastructure, right? They have to be data centers to power this, and energy is the backbone of every innovation, right? So the world is looking at the market is shifting to funding real-time solutions, real solutions that are solving real problems in the market, right? And working with founders, I've been working with founders now for the past 5 years, and also now working with founders in secondary cities like the Niger Delta region, from Delta State to River State to Bayelsa, in those regions where they still see, startup success as, let's just have this pitch deck. Let's just be able to craft this story. Let's move to Lagos. Then we'll be able to raise funds, right? So they just feel once you get to Lagos, right? There's some funding just waiting for you. You just need to make it to Lagos. Then you're going to get this funding. So now, I like the reality check. I like the fact that the reality is actually hitting deep. That if you're not building something if you're not building a solution that before your MVP is out, you're already you're having a validated market. You're already having offline revenues. You're already having pre-orders. You're already having a clear structure that your customers are willing to pay for this product. They are committing to pay for this product. Then I'm not sure you're going to raise funding now, in 2026. But I like the fact that 2026 is giving that shift, right? Where we're now focused on things that actually work, things that actually scale, and not just things that actually have vanity metrics. So yes, that's and that for me, and I look forward to sharing more, over the course of this discussion.
Thank you, Essay. Joyce, I would just say you give 2 words to this so that I can move quick into some questions. So Joyce, what's your own two words to this entire conversation? I know you made some foundational conversation earlier in your slides, but what just 2 words to add to what the speakers have said?
Yes, so I agree with the speakers. Everybody is seeing that there's paradigm shifts. DFIs are no longer something to easily come by. We have to work for it. We have to prove it. Founders have to show that their businesses actually deserve these funds. And again, Africa is no longer that place where we are waiting for hand-me-down kind of money. We are struggling, we are hungry. No, investors are seeing real opportunities. And because there's data, they are asking real questions. They are looking for businesses that actually can hold their space. And then there's a shift in mindset as well. Founders themselves are now looking inwards. What can we really do by ourselves now that external funding is probably maybe depleted or not as easy as it should be. We are seeing businesses that are collaborating across the region. So it's not just a Nigerian business, it's an African business in having distribution across different parts of Africa. We're also seeing businesses that are standing and holding their forth. Look at Dangote, is renowned globally, right? Look at Flutter Wave, look at Kobo 360. So these are businesses that are showing that there's a lot of opportunities in Africa that needs to be harnessed. So founders, we can look at their blueprints actually and see how they can also grow.
Thank you very much.
Thank you.
Yeah. So again, I just go with my next question. Why is capital becoming more disciplined in Africa, and where is it actually becoming more aggressive? Even if people aren't talking about it yet. Let's have your media. Why is capital becoming more disciplined in Africa, and where is it becoming more aggressive, even if people aren't talking about it?
Okay. So I would say that it's becoming more disciplined in, the traditional startup funding, where you see investors demanding stronger fundamentals, proof of revenue. They want to know what your real business traction is before they issue capital. Even in fintech, we've seen Nigerian-led VC inflows and big rounds. We've seen Money Points, I think about $120 million. We've seen Rainest. So the focus is like shifting towards the metrics, is shifting towards sustainability and the strategic partnerships rather than growth at all costs. So I have also seen so because we know that the fintech space, the sector is doing really well. So you see a lot of companies who are also trying to do this without any sort of structure. And so they focus on the growth, they focus on the numbers, they focus on just giving out what's it called now, incentives, giving out discounts just in a bid to gain that traction, but that is not sustainable. But I also think that is aggressively flowing into structured real asset and infrastructure plays where returns are clearer, they are long term. Joyce had just recently mentioned Dangote and even the likes of MTN. So you see these guys who try to raise capital, let's say through the debt market, either through like a commercial paper. It's very easy, for investors to really come into that space. We recently just did something for the embedded Nigerian the power sector anyways. I think they're looking to raise about 4 trillion, and we just raised I think in December about 501 billion. And a lot of investors geared towards that direction because they know that the security is there, they know that this is sustainable, they know that this is long term. So Nigeria is attracting significant investments in digital infrastructure as well. So I think that we are tightening discipline in early stage, high burn startup bets, people who comes with a lot of energy but without structure, and they are quite willing to deploy capital into tangible infrastructure, energy, and digital backbone projects. So yes.
Thank you very much, Lydia. Let's have you, Kayode. Where is capital becoming more disciplined in Africa, and then where is it becoming more aggressive?
Okay, thank you. To add to what Lydia said and Joyce, so naturally the overall quote these days is follow the money, right? As long as you can't see where the money is, you can't fund. And that's it. So, and in a country like Africa where the real problem is your factors of production, your value chain. If you're not an integrated business, nobody wants to fund you. So who are your off-takers? Where you get your supply from? Do you control your transportation, your storage, and cool. So what you see typically these days is real sector. There's more aggression in the real sector, like what Lydia said: power sector, energy, agriculture, from midstream, that's storage, processing, logistics, supply chain, trade, extractive industries like mining, are cool. Pure tech plays are becoming more disciplined, right? Typically because there's also that experience that has come from the last 5 years, but also is the fact that Africa is not a place where you can just run tech without controlling your factors of production operations. So I would rather fund a business that is already grounded and needs tech to scale than fund a tech business that wants to just bring people in, because it's hard to say you just want to provide let's say tech for a sector when you don't really control anything in that space. We have a very disintegrated value chain, and so if you look at successful business in Africa, they control everything. You have your transport, you have your power, you have your inputs end to end. So those are where the money is going to. If you look at companies that are closing deals, you can see it, and even from tech play, the likes of your Paystack and co. There's a reason why you see people buying microfinance, having a payment platform, buying a lending business, and all that, because they need to be integrated and ensure that you are retaining as much margins as possible. So those are where the money is going to, right? But if you just come up with ideas that cannot really tie the money and investors can't follow the money, nobody's going to cut a check for you. 5 years of instability has made capital wiser, right? People are smarter with money these days because a lot of people are getting their fingers burnt. From Ghana, there were bad debts in Ghana in different countries, and if you see that, it's just made capital providers smarter. So people are just following the money.
So follow the money. Kaede, thank you for that. Esther, let's follow the money on your own perspective.
Okay, so I think what has really changed is how risks is being like priced, whether capital is available. So this is actually the fundamental thing. Capital has clearly become like more disciplined in consumer facing models, especially consumer like fintech. We have a lot of those. Basically just replicating models around lending or anything that just relies on incentives to drive growth, and that is growth that cannot be intrinsically fund. So investors are now more focused on the quality of your revenue. Can your revenue be plowed back into your company to accelerate growth? You need to always look for external capital. So when we also look at where capital is aggressive, it is being tied to long-term structural companies that are actually solving long-term structural issues. And just like someone mentioned, climate and energy transition is a big one, and particularly around infrastructure. So businesses that actually provide infrastructure for other businesses to run. This is something very important right now, that businesses that provide the infrastructure or that provide services for other businesses to run is where investors are being aggressive right now, and we are seeing interest around healthcare, B2B platforms as well. As much as a lot of investors like to shy away from B2B because of the risks involved, but these are actually businesses that are embedded in other businesses. They quite have like a clear operating leverage. So overall, it doesn't feel like discipline is overriding like aggressiveness in Africa generally, but it just feels like investors are now focused on backing like fewer companies rather than before, where anyone with a shiny deck is just able to access capital without much discipline. Like due diligence in Africa is now much more in depth. So that's just my bit to say.
Thank you. Essay. Thank you very much, Esther. Essay, let's hear your own thoughts.
Yeah, thank you very much. You know, one thing I love about this conversation, it just feels like every one of us found ourselves in a place and we agreed to just root for the energy space. Right? And like, because I started catching this epiphany late last year, just looking at the oil and gas. I'm like, why are we just building some software? Like, are we looking at where this money is going? Like the
Follow the
oil and the
money. Follow
energy
the money.
space, because of this same energy space that the United States had to invade a sovereign nation because of this space. And I like the fact that everyone is looking towards that direction, right? Esther mentioned something very unique, B2B SaaS solution, right? So building tech solutions within these businesses, right? So now that we see that funding is moving towards infrastructure, look at recently, right? Not just the energy space, also the agtech space is also going to experience a lot of funding. Look at Sahel Capital. Sahel Capital just closed their fund two, closed a part of their fund two actually because they have a funding goal of about 75 million US dollars, but they've been able to close about 25 million US dollars already, right? That's to fund agribusinesses, right? So it tells you that the funding has shifted. Then also something that is very significant is policy backing. There's policy backing these sectors, the energy space, the agtech space, and not just policies but incentives. Like for instance, now if you're importing materials and equipment, because oil and gas equipments are actually very expensive. So if you're importing any equipment in the LNG space, the CNG, LPG, GTL, all of that, you have an import duty exemption, right? So you see, incentives are also moving heavily to those spaces to encourage more people to invest, to come into that space to play, right? So capital is becoming aggressive in those spaces. Now, capital is becoming disciplined in, let's look at the tech startup space. It's becoming disciplined in the pre-seed, right? So when you look at the tech space, it's the startups that are getting funding are not the pre-seed or even seed startup. We're looking at from the Series A or pre-Series A, right? They're trying to raise like a bridge round, right? And it is moving from the regular equity to blended finance. So we're looking at debt. So now with when you receive debt, that means you have to be accountable, right? Now we're looking at compatible notes, the traditional style that used to exist, because then with equity, the founder just feel this money is my money, right? It's my money. So I'm not owing any investor, right? So we can just wake up one morning and close shop, right? But now that it's debt, that you cannot close shop, they're going to absorb you, and Kiwi will probably be your next home, right? And whatnot. So now it's getting serious. So it is actually the founders that are true businessmen that are not looking at the startup space as a poverty alleviation scheme, right? Because at one point in time the startup space was beginning to look like the new Yahoo. It was beginning to look like that, right? You just need to build one product and the next minute you're going to raise funds, right? So that perception was growing, and I like this reality check that's actually happening. And I know that founders that are building for these real sectors, the energy space, the mobility space, logistics, right, agtech space, they're actually going to be the one getting the funding, and they're actually going to get it as much as they want, as long as they have the right structures around your businesses to drive growth at scale. Thank you very much.
Thank you very much, Essay. You already touched on some of the next question, or the next question I was going to ask. So, Joyce, what type of founders are finding it or would find it harder to fund, in 2026, and which of them will quietly, get funded?
Can you repeat the question?
What type of founders will find it hard getting funded in 2026, and which of them will quietly get funded? I know Essay had touched on a few of them, but let's get a few of them, from your own perspective. Just a minute,
Okay.
Joyce, just before you go, I just wanted to also introduce one of our speakers. Noah she's on the call. You're welcome. Can you just quickly do your intro, so that we can all just get to know you? I know this is quite putting you on the spot. The conversations have started already, but I already mentioned that you joined at 11. So thanks for joining. You can just give your intro.
Yes, thank you very much. Hello, everyone. Thank you for having me. My name is Noah Elkouti. I'm from Morocco. My interest in venture capital and in startups is more in the research side of things. My research studies concern the challenges that startups face while acquiring and mobilizing equity financing and equity funding. And so the challenges and the difficulties of Moroccan startups in the ecosystem. And so this is a brief introduction. I don't want to take a lot of time.
All right, thank you very much, Noah. We were just speaking around what type of founders would find it difficult to raise in 2026, or what type of startups would find it difficult to raise in 2026, and what type of startup would get funded in 2026 quietly. So, Joyce, back to you. Apologies for that break, and thanks for the opportunity to introduce Noah.
It's okay. Yeah, thank you very much. I know Kayode had mentioned that investors are going to be following their money. So definitely investors will be asking questions. So founders who are unable to answer questions will definitely have a tough time. If your housekeeping is not in order, you do not have financials that's justified, your business plans are not in order, you're not developing real business, you're not complying with regulations. Bottom line, your books are not in order, your business is not structured, weak governance controls, poor financial system. Those are questions that will be asked. Recently, we're looking at a company that had a fantastic idea of a business, had a fantastic business plan. Their financial model did not match reality at all. And that alone made them unbankable. So yeah, founders are going to be looking at investors are going to be looking for founders who are able to answer questions that justifies the money they're going to put down, right? Now, what are businesses that will be quietly funded? Businesses that are building real solid structures, solid foundations that have first, they're solving real problems. Two, they're growing and they're making profits. Three, they have a trajectory, right? They have strategy in place. They have clearly defined pathway as to how they intend to grow their business for the immediate term and for the long term. Businesses that have collaborated with strategic partners, whether in terms of their demand or in terms of their supplies, that are bridging the gap between their demand and supply, that are well structured as well. These businesses would quietly get funded. So it's not about making noise. It's not about being on TikTok. It's not about trending. It's about really doing the business, really being able to answer investors' questions and showing the investors where their money will be once they put it with you.
Thank you very much, Joyce. I think I will just take Lydia and Coyote's perspective to that, and then usher in some more questions for Joyce, Lydia, and Coyote before I move to the next speakers. So yeah, Lydia and Coyote, what type of founders will find it difficult to raise in 2026, and which of them or which type of founders would quietly raise money?
Okay. The founders that will struggle the most, those who rely mainly on their story. We've been talking about the storytelling thing, and I think it's a big deal. A lot of ideas, a lot of vision, but there is no strong execution. There is no proper structure. And to be honest, some of these investors, I mean, with VCs and the likes, they would, look critically into what you do. But investments can also come from other sources. And some of these investors do not necessarily have the time to hold you by the hand. So when you come and you're just giving story and there's no proper structure to the business, you find it very hard and difficult to raise fund. And I see this happening a lot with early stage startups in crowded sectors, consumer apps, and the likes of them, just burning cash. Then on the other hand, there are founders who are quietly just getting funded, like operators, people with proven execution skills, sometimes second-time founders. I recall Daystar Power in the energy sector. I think they were acquired by Shell.
Yeah.
Recently, and those guys are really doing well, attracting, because their model actually delivers predictable revenue and they are solving a real pain point. So one thing to solve a problem and one thing to have a structure, that is sustainable in solving, that problem for people. So it's so capital today is just moving towards structured and operational solutions rather than the whole hype and vision and ideas.
Wow.
Yes.
Kaide. Over to you.
Okay, yeah. From the capital standpoint, I mean, return of capital is now more important than return on capital, right? So you have to see your money come back first, and so nobody wants to fund. I mean, 10x and whatever is about steady cash flows. So the thing is, there's structure, right? So naturally, governance structure weak, you're gonna struggle. If you're not integrated, you're gonna struggle. If you're not generating cash flows, you're gonna struggle. If also you don't have like significant skin in the game, naturally, you will struggle. And then if you go to the other side where you have boring businesses who do the same thing, rinse and repeat, and just get innovative with integration, margin accretions, generating cash flows, solving problems across key sectors. Generally, you basically will attract the right capital. You attract capital generally. So that's just the difference. The difference is within structure and unstructure, value chain integration and non-value chain integration, governance, non-governance, and solving real problems or just doing what everybody is doing. Nobody is going to listen to the fact when you say unbanked population. It's not a story anybody's interested in anymore because there's a reason why they're unbanked and they will always remain unbanked, right? So I could tell you people say the banks see better, and if banks are not going to some sectors or some spaces, then there's really a reason why, right? It's more of risk than return. So if you're not de-risking your business and you're focused on growing your business without de-risking, or you're focused generating growth without making profits, or not maintaining as much margins as you can retain, naturally you would find it difficult and struggle to get funded.
Thank you. Kaide, over to you again. Just which sectors in Africa are overhyped going into this new year? Which sectors are overhyped? Which sectors would you say are overhyped? And which ones are underappreciated by just attracting small capital?
Okay, so in overhype, really, I don't think I would say there's an overhyped sector or not, but I would say that there are certain services and products that are overhyped because of the ability to scale naturally. But what you can tell, for example, is it still comes back to the economic dynamics about where are the opportunities, what are people buying. If the consumers are not there, then it's not a good sector generally. So on the value sectors are hospitality, logistics across board. If you look at a lot of businesses spend maybe 30% of their revenues on supply chain distribution. So logistics, storage across different sectors. Real estate, also energy, like we've been talking about. There's also waste. Waste itself, waste is broad. The circular economy, from scrap to steel to metals. There's also the mining and extractive industry. I think those sectors are actually still undervalued because there's quite a lot of opportunities in that space from just formalizing or from just fixing certain value chain disintegration. So they are quite undervalued. But when you come to the financial service space, when you also come to spaces in the financial services, I think some areas are already crowded. And so in that space, you think that a lot of names are overvalued. It's about cash flows. Nobody cares about, if you're worth something on paper, but you're not generating such that kind of amount, then it still does not make sense generally. So those ones, you basically see that there's no much, it's overvalued. And so you don't see that appetite in that space now.
All right. So Kaide, if I rephrase that question, is some of these sectors are overvalued?
Yes. I think that the fintech space is overvalued. Whereas the sector tech space are undervalued. So from agro-tech, logistics tech, and you have different of those kind of sector technology businesses. I think they are undervalued. And then the real sector businesses itself, there's still a lot of undervaluation in that space because people are not pricing the capacity, potential, scalability, and the cash flow generations of those guys. So they are quite undervalued. But when you come to the fintech space, there's quite a number of overvaluation there that you really won't touch.
Lydia, let's have your take before Joyce comes in.
So not much to say, but I totally agree with everything he has said. I kept on, I thought I was even on mute. I kept on affirming and concurring to everything he said.
All right, Joyce.
Well, for me, I think traditional brick and mortar businesses that were overhyped in the past will definitely struggle, right? Because there's interconnectivity, there's internet, there's online possibilities, and businesses who remain only visible in shops, in locations without actually going into that space will struggle. We've seen a lot of closures. ShopRite is one of them. Hudson in North America, big names that we used to know. So basically, to remain valid or valuable within the ecosystem, the company has to actually, or a business has to be aggressive and look at where opportunities continue to exist, especially in consumption. Africa is the second biggest continent, right? There are opportunities. The consumption is there. Consumption in terms of food, in terms of housing, healthcare, those are opportunities that really exist. Then power, energy, like we mentioned, Africa continues to hold a large base of energy. Those are opportunities to be tapped, and those sectors will not struggle.
Thank you. Thank you. So I would go back to ask you again, Joyce. What are those mistakes that you think that a lot of founders are likely to make? If they use any of those outdated playbooks from say 2022 to 2024?
Well, like we mentioned, there's been a lot of paradigm shifts. So it's like you're walking and they've moved to the carpets and you're still walking. Or there's a hole, everybody's avoiding the hole, and the founder continues to go in there. He will definitely get absorbed in the hole and fall. So paradigm has shifted, mindset has shifted into building real businesses, into maintaining proper structures, avoiding poor management, being able to justify figures behind the hype. So a business actually, or founders, need to focus on their housekeeping. I would continue to say this, from their staff to how they manage their businesses, to the structures they have, to how they are supporting their businesses, to ensuring that those businesses translate from figures to reality. All of those are very important for founders who continue or who want to remain in business and who want to attract the right capital.
Lydia, what would you say is the biggest strategic mistake founders are likely to make in 2026 if they keep going by the old playbook?
I like this question because I think that one of the things or one of the mistakes we see is the fact that founders and people try to do what worked, say, a few years ago, not focusing on the fact that policies have changed, focusing on the fact that the environment too has also changed. So we end up chasing growth at all cost. We're copying global ideas, without adapting it locally. And even aside copying global ideas, I also see, startups trying to copy the same strategies that bigger organizations implemented. And sometimes it doesn't work that way. You have to look at, what works for you as an organization. You have to look at your structure. You have to look at your local context. One of the things I think I heard somebody's, talking about this, and I think it's really valid. You see an organization who has structure, they've grown, and they've grown rapidly in numbers, in structure. And you see organizations, startups trying to poach the staff of those organizations into their own organizations and thinking that, that would perform some sort of magic. But sometimes we don't understand that these organizations already have structures in place before the best hands came on ground. So they came on ground, into structure. But sometimes, even as a startup, it's best to pick your people from the streets, the people who understand the environment better, the people who can have conversations better, the people who understand the policies of that, and not necessarily the people who, we have so we have this level we have this years of experience, we have this mindset. So I think all of that, are sort of mistakes that we or startups or founders you see make over time. Now, investors want businesses that can make money, that can survive shocks, that have systems in place to scale. So forgetting that if you forget, it means that you might also raise money once, but you struggle to grow when it really counts. So for early stage founders, what you should optimize in the next, what you should think of doing is just to make sure that you don't try to copy or replicate what other organizations have done. You don't try to copy what other systems have done. You don't try to copy what people have done even few years ago. What worked last year would not necessarily work this year. Even in my organization, we've seen that happen in the investment banking space. I'm sure a lot of us heard about the recapitalization that happened for investment bank, financial service sector. What used to be 150 million, it's now has grown to like 2 billion, has grown to like 7 billion. So how do you go from there? Would you use the same strategy from last year? And then with the new tax policies in place, would you use the same strategy that you were using before? Would you use the same strategy that the organizations were using, in running your own organization? So it wouldn't really work that way.
Thank you, Lydia. Kayode, would you say the 2022, 2024 playbooks might still be valuable in 2026 for founders?
No, not at all. I think there are just two things that can't work. If you focus on that, you make a mistake. One is growth over profit. No one really cares how much passes through you. What's more important is how much of that do you retain. You are not scalable by how much money you can make, but you are scalable by how much of that money you can retain. Margins makes you scale faster than I can. I mean, I can do 10,000 or 10 million volumes every day. If only 1,000 comes to you after, then you are unscalable. So profit over growth, that's one. And then secondly is really about macro and policy alignment. If you're not positioned well from a macro standpoint, try to be defensive to economic policies, indicators like FX, and also policy alignment, because we're in a continent where we're evolving, right, and things are shaping. So you have to be well positioned to the narrative across what sectors you are, tax policies and compliance. So those are two areas that it's a mistake if you don't follow, and it's also how you should look at it from the last 2 years. Growth over profit and macro and policy alignment.
Thank you very much, Kayode. I'm going to ask you this question. What does a fundable African startup actually look like in 2026? Beyond the pitch deck and buzzword.
Okay. I was really eager to answer the last question.
Okay, well, you can put your words to it. That's fine.
But I'm going to connect. The both of them because the similarities, right?
Yeah.
So a fundable startup in 2026 is made up of founders that are not delusional, right? It's made up of founders that are realistic, founders that have domain expertise, right? So gone are those days when a founder would just look at the trend and decide to build a replica. Now it's going to be made up of founders that are moving from the corporate space, probably have like over a decade experience working in corporate, working in the sector that they're trying to build for, right? One of the things that we really overlook that some of us know, right, is that one of the major reasons why MoneyPoint succeeded was because Tosin was already building apps, software for banks before he built MoneyPoint, right? One of the major, a fundable startup in 2026 is going to come from the place of domain expertise, right? They're going to be looking towards that. Then corporate governance is going to be very key. So from day one, a fundable startup has to start looking at people that are doing better than them in that space, have to start looking at structuring their startup from advisors to even having at least one director. Do you understand? So it's not going to be just me, right? And also, a fundable startup is going to be made up of a founder that does not see entrepreneurship as an avenue for him to become a boss. right?
Mm.
But he's going to see entrepreneurship as service.
Yeah.
Stewardship is not freedom. Like, I mean, the real founders know that you lose your sleep, you lose your food, you lose your peace when you go into entrepreneurship. So the founders that still think that, okay, let me leave my job so I'll be free, I'll do entrepreneurship so I'll be free, I'll live life on my own terms. No, you're not going to ever live life on your own terms. In fact, it is tougher because you you're going to be answerable to customers, you're going to be answerable to partners, you're going to be answerable to investors, and you're also going to be answerable to the government. And now that we know that tax policies are stiffening, right? You're going to be answerable to the government. You need to know your numbers. You need to, check and balance your books. So this fundable startup this in 2026 is not going to be the vanity metrics. It's going to come from a place of genuity, right? It's going to come from a place of genuity and real numbers, right? Real numbers and real evidence of customer funded growth, right? So yes, that's from a perspective, that's what a fundable startup in 2026 is going to look like.
I think you also touched on the playbook part of it, right? So just looking at all that, that wasn't in the previous playbook. So unless you have some other point to add to it, so but that's fine. I want us to have a twist to this. I know that a lot of us are from Nigeria, yeah, but let's see what a fundable startup look like in Morocco. Now, would you be kind to just unmute yourself and just speak to it beyond the pitch deck and buzzword? Do you also experience these buzzwords and pitch deck over there in Morocco?
Yes, of course. We have the hype, the startup hype in Morocco for the past 5 years or so. Everyone is starting startups, but sustaining the growth of the startup is the real question. But going back to your question about what's a fundable startup in Morocco, unfortunately, the funding atmosphere, I might say, is really restrained. We don't have a lot of funding opportunities, and so we have to fight for because you are from Nigeria.
Yeah.
80% of funding that comes to Africa goes to Nigeria, South Africa, Egypt, and Kenya. And so the 20% that we have left, we have to fight for it, the rest of Africa. And so startups have to admit the most signals to actually convince investors. And so a fundable startup in Morocco not only has to convince in terms of technology and scaling technology, but also the power of executing the technology, going to market, and so on. But also there is another side of convincing investors for markets like Morocco that are smaller than the top four, which is regional scaling. For me to convince an investor, I have to actually have a vision of scaling the startup, either North Africa or West Africa, going to the MENA region, the GCC region, or going to Europe. And so these are the main, I would say, the main signals that prove or convince the fundability of a startup. First, technology. Second, executing the technology. And third, scaling the startup regionally.
Beyond Morocco. Thank you very much. I think that's some insight you've shared with us, Nawa. Esther, let's have your perspective on what the fundable startup looks like in 2026. You've been doing scale across Africa, so let's have your perspective. And I'm happy that I was able to pull Naura's perspective to it. Have you done anything in Morocco as well, Esther? Okay, if Esther is not there, I'll drop that to you, Joyce. What does a fundable African startup look like for you? I think Esther dropped off the call.
Okay, so a fundable business in Africa is that business that is going beyond the noise, right? So it's not just about noise anymore. It's a business that is able to hold its forth. Let's look at what has happened before now. There has been COVID, there has been AI prevalence of virtual reality, there has been internet explosion, and there is more transparency. People are understanding how to connect the dots. So a business that is able to hold its pace and prevail beyond all of this would surely be one that would
be funded.
Get funded. So now let me break it down, because I also provide funding, and beyond all the generics, right? What specifically would get a founder funded? And I'm going to talk as if I'm looking at it. I'm looking at a founder's request right on my table. So first of all, we're going to be looking at the historicity of the business. How has this business been running before now? I keep emphasizing housekeeping. It's so important. I keep emphasizing proper structure, and I believe a lot of speakers have spoken about that, because you don't want to keep your money with flippant business managers. A founder that is disciplined financially in their operations, in their personality. Another thing that's important is integrity, right? You can never go wrong with someone who has integrity, with a business that is transparent, that has a culture of accountability, stewardship, where you can relate. So founders who are beyond the hype, beyond the noise, that are running real businesses, solving real problems, connecting with their demand, and as the source of supply, bridging that gap, I would continue to say would not struggle. They would find funding, because really funders are looking for where they can keep their funds or monies, and first of all, expect it to be repaid, and then they can have peace while their funds are with the founder. So a founder that is able to demonstrate that, hey, if you give me this money, I have my structure in place, I have a bankable business, and I have integrity, doesn't even have to make so much noise. Such businesses would actually attract investors, because it's like a magnet. It pulls investors to them, because that's what investors are looking for. They are looking for where they keep their money, and that money will return back to them in multiples, if possible.
All right. Thank you. Essay, what uniquely African advantages do you think that global investors still underestimate?
The good part is most global investors are now seeing it, but some of them, they were underestimating the two top resources. First, the people. Right? The people. Our human resource in Africa is what is going to power the innovation, the industrialization, and utilization of industries across the global market, right? Africa has the youngest population, right? Looking at Nigeria as well, has like youngest population, and there's a lot of export talent, right? And the global north, the global south, Europe, and all of those markets now, they are experiencing shortage, right, in terms of human resource. And the skilled talents that is going to service that industry is in Africa. Now, some of the global investors are still they're still blinded by what the media tells them. So they're still focused on conflict. Oh, it's a conflict zone. It's a no-go area. Whereas smart investors are actually trooping into Africa, right? They're trooping into Africa. The same Burkina Faso, the same. There are immense opportunities to tap into, right? That will be very valuable for your market, right? So two things: it's the human resource and the natural resources, right? Those key factors that some global investors, some not so smart global investors, are underestimating in Africa, and the smart ones are seeing the opportunities there, and they are keen into it, majorly, right? Look at the mineral sector. Look at lithium. We're looking at electric vehicles. We're looking at electric vehicles powering the mobility and logistics sector globally, right? Those minerals, those resources are coming from Africa, right? So
Yeah.
smart investors know that they need to partner with Africa. They need to do business in Africa to power those industries, to power their innovation, right? Then the not so smart ones are looking at the news and they're feeling like, oh, we cannot go there, right? So those are some of the things they're underestimating, and the smart ones are getting it right, getting it done, and doing business in Africa.
All right, now let me pull you into this conversation before I go to Esther. So what are those uniquely African advantages that you think that global investors are still underestimating from where you sit in Morocco?
So the question was, what are the advantages that
Yes,
investors overlook?
yes, or still underestimate.
Okay. I believe, I don't want to switch my answer to challenges because that's that's what my brain goes. But I believe that they overlook the power of connecting Africa.
Connecting Africa.
Africa is being, yes. Africa now, unfortunately, we still are experience some sort of divide regionally, the east, the west, the north, and the south. But I believe with new technologies, Africa is getting connected more than ever. And there is the power of connecting Africa, which eventually will help founder and investors to scale at an exponentially. And so I believe that in the next 5 years, Africa is going to be more connected, and it will be easier for founders to scale from region to region. Now we are seeing a lot of North African startups and founders focusing on West Africa, mainly because there is fluidity.
Yeah.
Yes, fluidity to reaching the region. And so this is the main take I would
Thank you.
say.
Thank you very much. Connecting Africa. Esther, let's jump on that question for you before I move to the next set of questions. Is Esther still there? Okay, so I'll move to my next question. Lydia, do you want to answer that question though? I know you have a very strong perspective around this. Would you want to just speak to that, Lydia?
Sorry, I had a connection
Okay,
lag.
that's fine.
Okay,
Okay, so do
sorry.
you want to speak
So,
now? Yeah, Esther.
yeah, so the African advantages that investors are still underestimating.
Yeah.
I think the biggest advantage that brought a lot of investors, global investors into Africa was the market size,
Yeah.
but that has changed over time. Quality of market size is actually being looked at right now than just the market size itself. So for now, I think the advantages that are still being undervalued or overlooked is the quality of the entrepreneurs. Building in Africa is like an execution hustle on its own. So if you see a founder that can come that builds like in this constraint driven environment and able to navigate their businesses, grow and still stay relevant, not just grow but still stay relevant over time, that is actually something that's
Investors should be pretty. Yeah.
yes, exactly. It should hold very tight. I mean, there are a lot of sectors that entrepreneurs are performing like extraordinarily. And in Africa also, you see that the kind of market we are in, apart from building your businesses, entrepreneurs are building infrastructure that has to make their business or their ideas actually work. And also, outside that, they are battling with currency devaluation. They are battling with interest rates, elevated interest rates. So I think I'm also coming from the perspective of what we do at Endeavor. At Endeavor, we focus more on the entrepreneur than the companies because we think the entrepreneur or the founder, rather than let me say founder, the founder is actually what we back. We believe founders are able to, a founder that is able to like build a company in Africa, in this kind of environment in Africa, they are able to actually replicate those. If you take a founder that has built a business in Africa to a stage where the company is actually able to like run on its own, those kind of founders are able to actually build in mature markets well, and mature market actually outside Africa well. So I think an advantage that Africa still has is the quality of the entrepreneurs that we have here.
Thank you very much, Esther.
Um,
Go ahead, Esther.
Please, I just want to drop one line to wrap that up, right? I think something they're also underestimating in Africa is the ability of African founders to do more with less, right?
Deep.
What we're able to do with the limited funding that we get compared to our other contemporaries in the global market, right? It's outstanding. So our ability to do more with less, which boils down to the resilience, right, in African founders, right? So I think that is also being underestimated. And when they begin to see that, I'm very sure they'll have good returns for their ILPs.
All right, thank you. Permit me to switch the question a bit because
Can I just say something?
I love this already. Go ahead.
It just totally aligns with what I was gonna say as well. And seriously, kudos to African founders and startups, because I think one thing that the global investors underestimate is how complex it is to build a business here, even when your idea is great. So they sometimes just assume that, it can scale fast like in other countries, but we don't account for things like the power, inconsistent power, the fragmented markets, the regulatory orders that we experience, the need for, strong local partnerships. And yeah, so it's really complex building a business here in Africa, here in Nigeria. You wake up one morning and there's a new policy. I'm here wondering what's going to happen to some asset management companies in the financial services space, with the new recapitalization, and the new tax policies as well. So everyone now has to readjust, even when it looks like your system is functioning, it's working. You now begin to re-strategize and see how you can align with the new regulatory orders that are being experienced. So yes.
All right. Thank you, Lydia. I think that's very, very good input. I think that's something I wanted to draw our attention to, was something that Noah also mentioned, that, funds are going to the west, and to other part of East Africa, as opposed to going to the north side of Africa. How do we think that, again, she said something around connected Africa, the funds needs to flow across Africa. The west and the east take the bulk of the chunk, while you have founders there. If we are struggling with even all that, they are looking at us in West Africa or in East Africa, that you're making the funds from the investor. They are also, and we are complaining that the investors are not funding, despite the challenges that founders go through over here. But someone is down there saying the funds are not even coming at all. So how was the perspective to this? How do you think that investors should think about investing across Africa? And then I'll go to Essay, and then Joyce, who sits in 300 and something offices in 100 and something countries.
So on this, I would say that I think the cross-border fund flows, they are beginning to pick up, but there's a lot of room to grow. And to be honest, some of this cannot happen just from the global investors end. It would happen from the strategic partnerships that we try to build. Yes, the strategic partnerships that we try to build amongst us here in Africa, within the countries. So investors, of course, would stick to familiar markets like Nigeria, like Kenya, like South Africa, because they understand somehow the regulations, the risk, associated risks. But capital can still flow widely if, yes, of course, they're clearer, there's currency stability, they are trusted local partners. But within the businesses, there has to be some level of strong collaborations that can also help, businesses to thrive into states, into countries. And I think that will help a great deal.
Interesting.
And also structured deals again and partnerships with local institutions. You're working with the banks, with DFIs and the likes of that. That would also help, in building the confidence to investors as well to invest in, some of these markets.
Interesting perspective. Now, do you want to go or Essay should just go? Essay, I really want to hear your perspective to this.
Okay, lovely. Now are you there? Okay, so firstly, I want you to know that we're in the west of Africa.
I'm here.
Okay, good. So I want you to pay attention to this, right? I want you to know that we are not, it's not magic. We're actually working 10 times harder, right? It is actually, we work 10 times harder to actually even get this funding that has come, into the region, right? And something I also like you to do, and the operators in your space in the Middle East and North Africa, is to come, visit, West Africa, come to Nigeria. I would gladly invite you, right? Come to Lagos, right, and see how people are doing business, right? See how people are doing business here. See how people are doing business through the tea canteen, right? And one beautiful thing about I'll speak for Nigeria, right, is the enabling environment, right? The enabling environment. And if you also look at some of the other countries like Egypt, they did something by creating the Startup Act, right? Nigeria also followed suit, right? So these policies, like the Startup Act, is a signal to global investors that this country is ready to do business. It is a signal that shows global investors that yes, this country is there. That there's an enabling environment. Through that you're promoting the ease of doing business. They know that there is investors protection. They know that there's incentives. Do you understand? So the incentives like maybe capital gain tax even, maybe tax even on their labeled startups and whatnot. So I'm speaking from a place of personal involvement in being part of the team. I worked in strategy and being part of the team that worked on the Nigerian Startup Act, and I saw how that passing the Nigerian Startup Act that been assented, how it actually changed the face of the startup and the venture capital landscape in Nigeria, right? How we drew, foreign direct investment as well. So look at the policies, right? Look at the enabling environment. Then another thing again is the perception, the culture, right? In North Africa, right? Investors are early stage investors, like angel investors. They like to invest, using convertible notes, meaning that I give you this principal, you have to give me interest. Now, in the northern part of Africa, there is the halal funding where you don't, the non-interest loan policy. So investors are looking at it that I cannot give you the value of my money today is not the same value of my money tomorrow. So am I supposed to give you this money and expect the same money back maybe some 5 years after, some 3 years after, and whatnot? So all of that is also affecting the way investment comes to that region, right? So when there is policies that actually enable, startup creation, startup growth, I promise you that automatically there are going to be a lot of foreign direct investment coming, to the region. But come to Lagos. Come to Lagos, like they say, Abibi, come to Dubai, come to Lagos, and see how Nigerians are actually doing it, how Nigerians are actually doing more with less. Thank you very much.
All right. Now, maybe you want to paint some perspective to that conversation. Would that be fine?
Yes, sure. It's actually there is some truth to what Bassey said about culture, about entrepreneurial culture.
Sorry, I can't really hear you. I don't know if that's the same for the rest of the audience, but
How can you hear me?
Yeah, we can hear you now.
Yeah, I said that the data about the top four of the top hubs that mobilize 80% of funding in Africa. I didn't specify North Africa as a comparative, but what I would say is that going back to the culture, to the entrepreneurial culture, I want to just add something. I believe that there is a difference between the Anglophone Africa and Francophone Africa.
Yeah.
I always bring it up in discussion with colleagues. There is the French influence of Franco-African countries that unfortunately we were impacted with more socialist approach to economy. Now we are living and we are working on actually going to more capitalist mindset and entrepreneurial mindset. So there is truth to what Issei said, that the culture, the entrepreneurial culture, the founders, there is a shift in the mindset of founders lately, but there is truth to how culture impacts funding and opportunities. But I would disagree with him in regards to efforts and to working hard. Doesn't really matter how hard you work if the funding really isn't interested in you. You know, if, for example, the Nigerian market has validated its value, Moroccan market is still trying to convince and still trying to emit the signals that needs to. So
thank you very much, Naoa, for some clarity. So Lydia, I'll go to you quickly. What are the macro signs that you are watching closely at right now? And maybe some founders might be ignoring. What are those macro signs that you are watching?
Okay, thanks. I think that one of the macro signal, it's that people are founders are actually ignoring is the sustained high cost of money combined with the FX pressure. We don't pay attention to it. We underlook it. Also, the capital routes no longer cheap. Naira is adjusting, so at every point in time, people have to be on their toes. People have to make sure that the policies in the country, the policies in the environment that you work, it's still adaptable to what your business is also bringing. Today, we know that the treasury bills, for instance, bonds, they are offering quite an attractive return as compared to. So investors are not just looking to invest in companies with companies with so much ideas. They are also looking for just safe places to actually park their money. So startups are no longer the default option for capital. So it means that FX volatility is the founders who actually rely on imports, who rely on are so much under pressure than they realize. So founders need to build better. Founders need to know that there are other options, aside investing just in startups, and thinking that startups are the next, or it's the next best thing, for investors, puts you in a position where you're now focused on ideas, you're focused on your pitch, you're focused on your delivery, you're focused on the outlook, you're focused on the presentation rather than the actual structure. So reality now is saying that plan for higher financing costs, plan for tighter liquidity, and also plan for smarter, cash management. I have experienced certain businesses who were fully funded as a matter of fact. Some of them, were sort of giving grants. Some of them were, it was just maybe based on a PRU. There was one, a startup, they gave them all the resources that they needed, the assets, everything that they needed to start up that business. And it didn't take up to 6 months. That business, folded up. And we see this repeating over and over again. So we need to understand the fact that capital, it's not just enough. It's not just enough when you say you have enough capital to start up your business. The structure and sustainability needs to be there.
Thank you very much, Lydia. Esther, let's have your view, and then I'll take Joyce and Essay as well as Naoa. What macro signs are you watching most closely in Africa right now that founders are ignoring?
Okay, so macroeconomic signs in Africa right now, And we could already see the downtrend of interest rate across like economies, countries, which is owing to the fact that inflation moderated. And I think while some founders are already looking at debt as a form of capital rather than majorly on equity, I think many more aren't looking at debt quite much yet. With reduced interest rates, debt ordinarily is a cheaper form of capital, but with reduced interest rate, I think founders should actually start looking more at debt as a form of capital that could actually help them scale. I think a number of speakers have spoken about this already, and the fact that if a founder is raising equity, they're mostly raising dollar denominated funds in equity, but for debt, they are local like funds or local institutional funds that can give like debt capital to actually scale. So I think that's for macroeconomics, interest rates, lower inflation, interest translating to also lower interest rates. And also currency currency across economy is stable. Let's take Nigeria for instance. We've seen like appreciation just this year, and last year it was mostly stable as compared to 2023 and 2024, where the devaluation and the depreciation happened. So with stable currency, it means that valuation, because most of these businesses, their operations are quoted in naira. So valuation in USD, because a lot of investors like to hear USD. Speak to me in USD terms, not naira terms. So I think valuation right now would be more attractive as well. And also something else in macroeconomic is, well, maybe not macroeconomic, that would be fundraising. So I think I'd like to hold that thought to myself.
All right, thank you very much. Let's have you, Lydia. Oh, sorry, essay. Sorry, essay.
Okay, thank you very much.
What are the macroeconomic signals that you see that founders are not paying attention to?
Okay, so first, it's the government shift. So government across the board, they are now focused on the startup and innovation landscape, right? When the boom started, they were confused. So that time they were just putting restrictions. With what are these people doing? Fintech, what's that? Crypto, what's that? Right? We're just putting restrictions. But now they are coming to fully understand. Like, look at how much revenue that the electronic money transfer levy brought to Nigeria last year alone, right? So now you're looking at it that, okay, if we give these people a soft landing, if we collaboratively work with this part of the economy, the digital economy, let's look at that, the digital economy, there's more to gain, right? Look at what recently Kuda, Opay, MoneyPoint are now a full-fledged bank, right? So that means one major signal we're going to see this year is government backing startups. This is not, the traditional VCs or angels. Actually, the government backing startup.
Already.
Last year.
I said there are funds already. Go ahead.
Good. So you see, last year, there's the IDICE fund, which is the investment for the creative, digital and the creative economy, right? And last year, Ventures Platform was part of the venture capital firm that got part of that funding. So that means this year, those fundings will be deployed. And take note that funding, was an aggregated funding from the Bank of Industry, the Islamic Bank, and the African Development Bank, pulled together to actually fund innovation, right? And the digital economy across Africa and Nigeria, right, also got that. So this year, we're going to be seeing that the government is going to be backing startups, is going to be backing innovation it's going to back innovation deliberately and consciously. They're not going to be doing it from the sidewalks anymore. So that shift is because they're looking at ways to also increase the GDP. They're looking at ways to also increase the value of the economy, right? So now they're not overlooking that industry anymore. So one thing that startups will enjoy this year is backing from the government, right? And unlike before, startups that actually are compliant, startups that actually are focused on government relations, right? Understanding the laws, the policies, and also building relationship, with government, right? Understanding the direction in which got the government across the board, the heading towards will actually benefit greatly in this year 2026. Yes, thank you very much.
Thank you, Essay. Joyce, do you want to add anything to that before I ask the next question?
Of course, yes. So yeah, so for from my standpoint, looking globally, economies that are getting reformed and positioning themselves would generally be saying something different. So the macroeconomics in my own from my own perspective would be economic reform. So why, for example, is East Africa attracting funds right now rather than other parts of Africa? Because there's a lot of economic reform going on there. Look at Rwanda, look at Zambia. Yeah, I was reading in the papers recently that Zambia is attracting a lot of funding, especially into their energy sector. So definitely economies that are doing reformations and are positioning themselves would be an attractive venue. And places that are sluggish, like in South Africa, historically South Africa was attracting funds 2026 onwards, except something changes significantly. South Africa is going to be sluggishly getting funded. Another area to look at, my colleagues here have spoken about debt funding. Yes, that's critical. But another area to look at would be securitization of those debts. So risk management would be an area to look at. How are you managing the risk around the funding? That's a critical area to look at. So when the decision was being made about what factors to consider when providing funding, developed countries sat down and set up the blueprints. And they operate different type of economy, right? They have structures in place, so you can sit from the comforts of your home and get funding. You don't have to work so hard like we're doing in Africa. They have documentation, they have systems that are structured and work. In Africa, unfortunately, we still have weak institutions, as institutions are not so structured, but we have strong individuals, which is the reverse. So we struggle with raising funding. So honestly, to have funding flow to us, we have to rewrite a story, either to match with the blueprints, the global blueprints for attracting funding, or we develop our own system, right? Which is even more difficult. So the macroeconomics for me to watch out for is stability. Let's stabilize our foreign exchange, through proper stabilized systems, or have structured systems that work and make it easier for businesses to grow.
Thank you very much.
Thank you.
I'm going to ask just 3 more questions and we call it a wrap. What are those assumptions about African market that you're no longer going to hold going into 2026? I will start with Esther. What are those assumptions about the African market that no longer holds grounds in 2026?
I would say the market size. A lot of investors trooped into Africa due to the market size, thinking, demand would always settle for, like, demand is there, just needs supply. Yeah, supply of ideas, a supply of solutions. But this is not playing well because we've seen a lot of startups wrapped up, even though the demand is definitely there. It's just the execution of the solution that add like some constraints. So I think that mindset that Africa has the market size to actually make anything work is I don't think that is holding anymore. Right? Is that your question?
Yeah, that's fine. That's an assumption.
Yeah.
Thank you very much.
Yes.
All right. Lydia, let's have you before I go to Naoa, Essay, and Joyce.
Okay. Thanks. I would say one assumption is that I think no longer holds is that only a few countries now dominate opportunities. Yeah, so we have countries like Nigeria, South Africa, Kenya, excuse me, and we see that these countries are, yes, they remain key hubs, but we're also seeing viable opportunities in other markets. We're also seeing, and these countries, Rwanda, Cote d'Ivoire, some other countries, they're beginning to also build like solid partnerships, and so I think that the opportunities there that are usually overlooked, and we can actually just pay attention to those places as well, especially when founders are beginning to build like cross-border relationships and strategies into those space. Also, I think that the fact that people focus on growth, thinking that the high growth alone guarantees that funding, it guarantees success for your organizations. I think that has been like the mindset over time, but the market is now mature. Investors are now beginning to look for strong unit economics. They're looking for operational discipline, before they invest in certain organizations. Yeah.
Thank you. I'm just
And
going
also, just one final one. I think also thinking that venture capital, it's just one way, to scale. Of funding. Someone has also mentioned, around equity, focusing on equity. I think structured debt as well really helps. Blended finance, strategic partnerships with people are also becoming very important funding path. There's some set of partnerships or sort of partnership that you build with certain partners or organizations, and you would not even require, high level of capital, and especially for sectors that are really doing well in capital intensive sectors, per se. So yeah, thank you.
Thank you very much. Essay, let's have you. There's one question in my head that I would put down once we're done with this round.
Okay.
Yeah.
Okay, so I'm just going to buttress on what Esther said earlier. So the assumption of let's build a solution because Africa has the market would follow. I bet anyone that goes that route this year, everywhere go first blow because anyone that goes that route, nah. So, and there was this focus on there's this assumption on there's a gap in the market, right? So there's a gap in the market. Africa has a big total addressable market. There's a gap in the market. There's this gap in the market. So we want to bridge this gap without investigating if there's a market in the gap, right? Some people have problems they don't want to be fixed. In fact, that problem is what makes them relevant. They like the hard work, right? They want to suffer from that problem, right? So founders and startups that are able to actually discover, not just discover, but they're also able to establish, right, that there is actually a market in that gap, that people are actually willing to pay, not just willing to pay, people are actually ready to pay, in the sense that you're pitching your solution that you've not built and your target market is saying, bring it, we want to pay. When should we start paying for it, right? People that are ready to pay, no longer willing to pay because wishful thinking, wishes can actually change. So that are ready to pay, right, would actually get it. So that assumption that, okay, there's a gap in the market, no. It has to now move to the reality of is there a market in that gap, right? And it's not just building solutions that the market will follow, but it's building solutions that the market has asked, right? That the market demand is actually validated. So you're building a solution that already has a ready market waiting to use it instead of the other way around.
Thank you, Essay. Let's have you now, and then Joyce.
Sure. For me, I would say that the assumption is that Africa needs foreign funding to grow. Yeah, that Africa we need foreign investments. Maybe it is the case for private equity, M&A, and stocks, But for early stage startups and venture capital, I believe that um, Africa needs Africa, and Africans actually need to fund Africans. I say that because there was a peer-reviewed article published last year about funding discrimination, how foreign investment goes to actually non-African founders. And so I believe that starting 2026, Africans need to build Africa and need to invest in Africans. Um, yeah.
Thank you very much for that perspective. Joyce, what's your perspective?
So from my perspective, the assumption that Africa is a continent of hand-me-downs has totally changed. We are no longer a dump site. You know what is happening in Congo? People are speaking, they are talking about it. Nobody will try that again. Nobody will dump rubbish in Africa anymore. We are no longer that country where you're trying to provide funding to alleviate poverty. No, that's no longer Africa. So today's Africa has changed the narrative. We have shown that there are opportunities, that we have population with real demand. We have also shown that we have talents. We have young talents that are prospering and have demonstrated that they can build global values. We have Tokpe Awotona of Calendly sitting out there in the US developing solutions. We have Silas Adekunle, I think, the guy who did the robots, the gaming robots. We even have a young girl who developed an app that is solving mathematical challenges for young people. So it all shows here that all those assumptions that kept Africa in the dark or that made Africa look weak have to be completely erased, because Africa is strong with opportunities. The only thing holding us back is our housekeeping, managing our risk properly, and documenting our story the right way, speaking the language that the investor needs to hear.
Thank you very much. And this brings the twist for me. Is language a barrier to funding, saying that Anglophone Africa is doing better than Francophone or the Portuguese-speaking countries? Or is it that their stories are not being amplified the way the Anglophone African countries do it? I'm going to open this question to three people. So the three can just pick themselves. So whoever wants to answer that question, is language a barrier to funding, saying that Anglophone Africa is doing better than Francophone or the Portuguese-speaking countries? Or is it that the stories are not being amplified? Is this that the stories are not being amplified the way the Anglophone countries Africa is amplifying its own stories when they raise funds? Now, I see you.
Yes.
Yeah.
Yes, I would just jump in to talk about the concept of homophilia, how investors invest or decision makers choose or invest in founders that look like them, speak like them, or have the same. And so this concept of homophilia actually is can be the response to your question. How language, for example, if it's an American fund or if it's a British fund, of course they are going to invest in more Anglo-speaking founders. That's why when I spoke about Anglo-Africa versus Franco-Africa, I spoke about the impact on cultural, of entrepreneurial culture. And so, yeah, my answer to your question is how homophilia actually impacts the decision making of investors.
Thank you very much, Nawa. Anybody wants to take a twist on this? Lydia, Essay, and Joyce.
Okay.
Esther, I also want to see your perspective to this.
Okay, so let's treat it as it is, right? So Francophone means that you're basically dominated by France, right? Portuguese will mean you are dominated by the European market, right? And Anglophone means the English-speaking countries from North America, UK, and other English-speaking countries. So now the global powers that dominate the Anglophone, the Anglophone countries, the English-speaking countries, they are more open to funding. They are capitalist. Do you understand? So the behavior of the overhacking body towards funding, towards investment, towards innovation is broader. And that is why Anglophone, speaking countries have benefited. Do you understand? Right? If you look at it from the Francophone side, though um, that is also something we should look out for in 2026, though the Francophone speaking countries are showing that they have the capacity. So they are speaking up, and Joyce also mentioned that they're speaking up. So we're going to see some we're going to see funds. This year, we're going to see funds because I'm currently in the VC program. We're trying to raise a fund for the Niger Delta region, and I saw Francophone emerging managers from Senegal, Cameroon. They are raising funds for their geographies, right? So a shift is happening, but why Anglophone is doing better is because of the the overhacking body that has controlled our market, has controlled the market in which we operate, right? And that is pretty much the advantage. Now, if you look at the European market, that's for the Portuguese. If you look at the European market, funding is very stringent in the European market. It's not given out like that. It's very stringent. The policies, the interest rate, even from LPs to VCs, right? So from LPs to VCs, that there's a structure. There's a structure when the VCs are to return funds to the LPs, where I think there's something called the waterfall method, where for the European method, the LPs must receive all that they gave with all their interest before the general partners in the VC fund will get anything, right? So it's just pretty much like the GPs in the VC fund in the European market are just working for their LPs, right? Nothing for them. So you see that structure makes it harder for VC funds to emerge, and VC funds needs to emerge to take a bet on the innovation and startups around that sector, right, in that geography. So you see some of this structure, some of these methodologies that already exist in this market, right? The Portuguese francophone market are some of the impediments to why startup growth and investment growth is not moving as fast as it should compared to the anglophone market.
Thank you very much. Lydia.
Okay. Oh,
Okay, Esther, go. Let's go. Esther, you.
okay. I mean, this is a bit interesting because when you look at the Endeavor, we're in 45 plus markets around the globe. And we're talking about LATAM, talking about Asia, talking about Africa here. But in Africa here, we're mostly in Anglophone countries. But yes, language can be a barrier. And I think it is more of an indirect barrier rather than a fundamental one. So, and I like to bring Endeavor into perspective here. We operate in like 45 plus markets around the world. And we're talking about Latin America, that's LATAM, Middle East, Asia, Africa. This is like from these, about more than 30 languages spoken in these countries or in these markets, but it doesn't affect if funds actually flow into this market. Firstly, I think language affects like investors network kind of. When you look at Africa, a lot of institutional venture capital in Africa, they are still concentrated in predominantly English speaking like hubs. I mean, the four major hubs of Africa, they are English speaking. So founders in francophone ecosystem, it's not like they don't have those strong businesses, but they often face that visibility and connectivity gap. I've been in a room with French speaking ecosystem players, and I could barely communicate. I was in that room for 3 hours, but we needed an interpreter to interpret what each party was saying. It lacks the process behind, but it doesn't max value. So I think the problem is not that language actually impedes how much trust that goes into these francophone countries. And I also think due diligence from at VC stage has passed the stage where we investors only look at or only want to hear from the founders. There are a lot of ways to actually know about a business than just hearing from the founders. Sure, a pitch is actually important to even pick curiosity first or make an impression first, but it's also about eventual like understanding what the business is and whether the fundamentals are strong. So I think language truly it shapes ecosystem and it is a barrier to an extent, but I don't think it is a barrier in all totality of it. And when you look at for instance, in Endeavor now, we know that the opportunities are there in these francophone countries, like in Africa. But what we are doing right now, because most of our mentors are English speaking mentors, like within Africa. But when we look at foreign mentors, like I mentioned, we're in other markets, and some of these markets have some English speaking populations within them as well. And many founders are bilingual and all. So I think the ecosystem should try to immerse into the francophone countries as well, and not just leave them bare. I think the map currently in Africa is just chatting through the English speaking countries alone. So I think there's still a lot of work to do to actually bring them into the ecosystem as a whole in Africa, but there's a lot of opportunities there that can
Thank
be
you.
tapped.
Thank you, Esther. I'll take Nawa's point again. Connected Africa. That's what the funds needs to look like. But let me hear Lydia's perspective. I won't put my perspective to it. Joyce, I see your mic is unmuted. Did I steal the mic from you?
No, I wanted to actually comment. Okay, can I go ahead or
Lydia,
the
what do
other
you
person
think? I
should?
think you can go
Yeah,
ahead.
maybe Lydia should speak.
All right. So yeah, I totally agree. Connected Africa, collaboration and partnerships. I'm very big on that because I have seen what strategic partnerships, interstate, cross-border has really helped with. We can't talk about language being a barrier, especially with the global investors, when even within Africa, we are looking at it as a barrier.
Yeah.
Nigeria is looking at it as a barrier so how then would even the global investors, relate with them? So if there is a place of collaboration, I think that would help. Language is a barrier, and we cannot even take that out. However, there should also be focus on visibility. There should also be focus on amplification. Now, the francophone speaking countries, what can you do better? For some of the industries that are already working really well, what did they do better, and how best can it be amplified? How can you collaborate with other African countries and see how to, bridge this gap and limitation? So yes.
Thank you. Thank you very much. Joyce, your take.
Yeah, so for me, I would like to give some back story and look at it from the area of costs. Roots, costs, and effects. So if we look at the Anglophone countries, there's a lot of noise. I think there are more Anglophone countries in Africa, right? And look at who colonized us. They were dominant people, small but mighty, right? Britain, small but mighty. And because of that, we tend to follow their style. Investors in Anglophone countries, they are very stringent in providing funding, but at the same time, they give room for autonomy. So as founders in African countries, we have more autonomy. We have to prove our value. We have to make noise to actually be seen because we are following in the steps, kind of, whether we like it or not, of, people that we have as partners. Now look at in Francophone countries, there's less noise. It doesn't mean they are not getting funded. They just have less noise. And if you also look at their pattern, they have a lot more dependence on their original colonizers, unfortunately, right? So they make it much easier for them. They are more dependent, kind of. So I'll give an example. I had a friend at the time who was manning West African Venture Fund, sitting there, but he couldn't fund Anglophone countries. because the fund was specifically for Francophone countries. There wasn't much noise. People didn't have to go through the hurdles that we have to go through in order to get funding. You just needed to show that you had a business. Securitization was less stringent and funding easily flowed. So give and take, I would say that it depends on the space where you're operating. Anglophone countries have their own system of funding. Francophone countries have their own system of funding. Now let's connect the dots. How can we have a connected Africa? Language is a barrier, I agree. I remember there was a time I got a funding proposal that was all in French. I tried to do Google Translate. It was a headache. So it was very difficult. So the first thing would be focus where you have you're able to speak the language and be on the same terms. However, that doesn't limit connecting businesses. We have regional businesses that are taking advantage of either bilingual people or people who understand the landscape. We have Nigerians who are working out there in Francophone countries. We also have Francophone individuals working in Anglophone countries across borders. So there's nothing wrong in learning languages if you actually want to be international in doing business, whether you're a founder or whether you're investing. There's also an advantage in engaging people who can operate in this space. Definitely having businesses that are connected, regardless of language barriers, always has an advantage. It shouldn't really be a barrier, but we cannot underestimate the fact that it's currently a barrier. But then that barrier can be overcome by having the right people doing the work and also learning the language.
Thank you very much.
Thank you.
And I think this takes me to my last question. Is venture capital still the right path for most African founders in 2026? I think we've answered that question around look at debt and the rest of it. So I'll flip the question again and merge it into two. Is venture capital still the right path for most African founders in 2026? And is the future of African startups still concentrated in few cities, or we need to see it in we need to think about it from the perspective of new, hubs emerging? So those are my two questions. I know SA is very happy about this, but let me let SA go first. I know you're excited about it.
Thank you very much. I mean, secondary cities are emerging, right? It's not business as usual. Look at late last year. Just look at last year, right? Sitemap is based in Port Harcourt, right? Got funded. Terra raised about $11 million. They're based in Abuja. They got funded. So the shift is moving. The major cities, Lagos, Nairobi, Cairo, it's moving. It's moving. And secondary cities, there's going to be a lot of boom coming from that space, right? And there are also another thing I noticed again is now there are niche funding, right, to specific regions, right? Because even the fund that we are raising for the Niger Delta region is because we saw, right, some other people raising funds for specific regions, right, specific zones, right, to fund businesses in those secondary cities. So we thought about it as well, and with what we are also doing at Delta First Fund, definitely we know that it's not business as usual, right? It's not business as usual. So it's not going to be focused on the few cities that we know. It is diverse into other secondary cities as well. Then, is venture capital still the right path for most African founders in 2026? African founders that have proven track record, African founders that have validated market growth, African founders that are post-revenue, yes, right? For African founders that are still at the pre-revenue stage, pre-MVP stage, they need to leverage their network. Right? They need to leverage their network. They need to, meet their friends, they need to leverage friends and family, right? And they need to build integrity in that space, right, before they think about venture capital, because venture capital funding is not exactly going to come to idea stage or concept stage or just waiting list stage. There's this wait list, we have this on our wait list and whatnot. It's going to come to proven record, right? So they should not waste their time just jump into VCs because they have an idea. They should leverage their existing networks, right? In fact, they should focus on what I like. What I like the most is customer funded growth. I love customer funded growth. You have an idea, go straight to the people that you want to service, go straight to the market that you want to service, right? Let me just quickly give a quick example to something that I did, right? I wanted to get into the oil and gas, right? I wanted to get into the oil and gas sector. I saw the boom and all that. I did not focus on just going to register a business and whatnot. It's a highly regulated space. I did not focus on that. I went straight to the people I wanted to service, which are the downstream sector, right? And I narrowed down the solution to the barest minimum. So what we wanted to go into was EPC, engineering, procurement, and construction of CNG and LNG facilities, right? That's the big scale, right? That's the big scale. So I narrowed down to, that is big, having those equipment. I said, okay, let me sell the barest minimum, which is feasibility studies. So I went to the place and said, okay, there's this opportunity in the CNG and LNG space, right? The policy backing and whatnot, right? And I showed them what they stand to gain, how much revenue they stand to earn, how much market expansion and growth they stand to experience. But I said, before we say you should invest, we'll suggest that you do a feasibility studies, right? So also a feasibility studies. We're not selling feasibility studies as a solution first to this market. And interestingly, what we thought the market was going to pay us, the pricing that we thought we're thinking about just a few millions, then by the time we proposed that, this client was telling us, oh, are we going to manage so in, beyond what we thought we were going to charge for this, right? So through that, we're able to get that, so the first funding that will go was from the customer. We had not even registered the business. That was what we used to register the business, get the licenses, and get the next project and the next project, and like that, right? So this year it's pretty much about customer funded growth. Go straight. You have this idea, you have the solution you want to build. Go straight to who you want, to pay for the solution and begin to sell to them. Right. So, and that should actually be the focal point instead of just looking for investors to throw in fund into vibes without any realistic potential in that business or solution that you're looking at.
Thank you very much, Essay. Let's have you, Lydia.
Okay. Thank you. So I think, yes, venture capital still works, but I also think it's no longer the default because funding is now tighter. Investors are really looking for companies with real traction. And I also believe that not every business needs a VC to succeed. It's important that we focus even more on our internal processes, get that right, focus on your revenue growth. You're growing your own business using your cash flow, your early customer revenue. You can't take that out. And I think that many SMEs have also successfully grown and scaled in this direction before any form of external funding. Then secondly, we had also mentioned a couple of times around debt financing, looking out for structured loans, from banks, from development finance, just structured lending, right? And that's why you see some organizations today, rather than going directly to a bank, you see them raising things like commercial papers and the likes, And then a lot of startups and founders, don't really pay attention to grants and development funding. And I think, that's something that can actually go a long way. You can get, have access to information, because when you have the information, you would know that, okay, certain opportunities are in certain places, right? You could get capital from government, you could get from foundations, there are programs like the Tony Elumelu Foundation in Africa, Flourish Africa, owned by Mrs. Folorunsho Alakija. There are just some other grants that, people could actually take advantage of. And sometimes you don't need to have that so much, to begin with, because even getting a lot of capital also attracts, high interest rates and all of that. You want to build your business to a certain position where you can now say, okay, you're looking for structured funding. Also, corporate partnerships is something that we overlook. You could partner with corporates, you could partner with financial organizations, and see how these partnerships can be mutually beneficial, because most of the time we go with our own request. This is what I want to get. This is what I want to get. How about the value that you're bringing, to the other party? So yes, I think this also would go a long way. Angel investors, they are people, just hiding somewhere looking for, where to invest in, some high net worth individuals. And that is why partnerships, again, relationships, it's equally important. So yes, VC, good, but there are other strategies that you could explore that, can actually give you more results.
All right. So part B of that question is that is the future of African startups still concentrated in few cities, or we are about to see some new hubs emerge?
Oh, I think that we're already seeing new hubs emerge. And that's why people, even investors, are no longer like focusing on, just the regular countries that we know that these are key players. There are new hubs, there are new industries, there are new countries as well emerging, even through cities like Lagos, Nairobi, Dresden. Yes, they remain important, but they are also secondary cities. For us at my organization, we're already looking to expand in other spaces that, are quite silent, but there are a lot of wins, going on in that direction. So, yeah.
All right. Thank you very much, Lydia. Now, I'll let you have the floor now.
I think by definition, venture capital is needed for startups. Um, so yes, it is needed, um, especially for early stage startups, because later from seed to Series A, we are seeing that startups are choosing debt capital more, but for early stage, I believe that VC is actually important. For the next question about the concentration, can you repeat it, please?
If the
About the
future of
cities.
African startup is still concentrated in few cities, or other regions are emerging?
Other regions are emerging. I believe that we are going to see, for example, in North Africa, Tunisia are making an uh, amazing efforts, and we are seeing the results of their efforts. So yes, Morocco also. I believe that Morocco in the next few years we are going to see uh, emerging startups and founders.
Joyce.
Okay. I think maybe this will be my last because I started at 4 a.m. I'm off here in Toronto and I'm feeling still a little bit sleepy. So
Sorry about that.
yes. Okay, I'm actually enjoying the conversations. Okay, so about the venture capital. Oh, sorry. No, we're talking about the cities, right?
Yes, emerging
The
cities, and is ventures capital still the right path for most African founders?
So first about the emerging cities. Well, good enough. There's digitization, there's information accessible to everybody, there's internet, so nowhere is hidden anymore, right? So it's no longer about noise. I can make the noise and I'm visible. That's in the past now. Even smaller cities that are doing wonders, smaller countries that are doing wonders can now be visible. So definitely there's going to be a paradigm shift. Investors will begin to look for those quiet companies that are creating value across the ecosystem. For example, 2026, some countries are already being predicted to become visible. We have countries like Ethiopia, where like approximately 7 to 10% growth is expected. We have Rwanda coming up there, even Uganda, South Sudan, Kenya, Zambia, like I mentioned earlier, they are attracting funding. And of course, Nigeria continues to remain in the in that space. So yes, there's going to be new avenues opening across board. Then venture capital, that's a tough one. The question will be for investors. Do I want to invest blindly or do I want to invest based on information? If a startup is able to answer the questions, yes, it will continue to attract funding. However, there's always opportunity cost at every point in time. So venture capital may not be something so easy to come across, except where the business is able to prove its value to the investors. But there continue to be availability of other sources of fund. There'll be debt capital at all times. And collaboration, partnerships. There would be, I foresee some mergers and acquisitions along the line, even that's going to be happening in Africa, because with more information, people are more positioned, and with more transparency, people can have more reliance and trust to do businesses together.
Thank you very much. Thank you very much. I don't know if you have questions
Oh,
from
thank
the
you very much. I don't know if
if you have
anybody has
questions
direct
from the
questions.
yeah. All right.
Otherwise, I would like to call it a day. Have a
Thank you very
wonderful
much,
rest of the
Joyce.
session.
Thank you very
Okay,
much,
then.
Joyce. I think we're
Bye
done
then.
already. Thank you very much. I don't know if there are questions for us from the audience, but that will be it all. I just want to say thank you to you all for taking time to join us on this 2026 outlook, market outlook, where we identified where Africa's opportunities are forming. It's been a very insightful session for us. Okay, there's a question. DMS.
Yes. Thank you very much. Thank you very much for the wonderful presentation. Nice to be on the call. Well done, Umbrella. It's been very nice following up on the progress. So I wanted to ask, everybody have said a lot, but we didn't talk about how to contact, how to reach out. Okay, for introduction, my name is Dr. Onyilade. I'm a co-founder and CEO at Springita. Springita, we develop AI agents for businesses to be able to use and manage, to use in operation and also manage their sales. So I've listened to interesting speakers from Linda to Russell, and I think they're all exciting and happy to be on this call. So I want to know, after this call, how do we engage?
All right, thank you very much. I want to believe that a lot of them are on LinkedIn. You can just find them by their name, engage them with your sales speech or your conversations. I think you can reach out to them through that channel. I'm sure that's what most of them would say, but anyone who is willing to share that direct contact, please do that through the chat box. That's also fine. But yeah, I think that one of the ways you can reach them is through LinkedIn. Just directly look for the names of the speakers, speak to them, pertaining what you want to say. And I'm sure that if they find it interesting, they would engage with you. Yeah, thank you, Doctor. Any other questions so that we can call it a wrap? I want to ensure that we close by 1. This is the first session that would have 6 speakers at once. We've never done that before. It was quite engaging. It was quite interesting. It was very lengthy as well. The wealth of the conversations I enjoyed because I saw from different perspective, different from what we usually would do at Umbrella Saturday, where we have just one speaker speak to us and then we'll ask questions. Thank you very much, everyone. From Nawa taking time from Morocco, from SA taking time from your Niger Delta region, let me put it that way, from Lydia, for doing the best and doing the most. To Esther for being a part of this party and this conversation. She's no longer here. Kayode, amazing speaker as well. I like the wealth of the conversation as well. I'm going to look for him and bring you guys back. Let me just say that I'm going to bring you guys back on one session, individual sessions, at the end of the year, which is somewhere around December, where we review the signals that we saw in these conversations and say, oh, you said this, so it didn't happen or it happened, so please, I'll reach out again towards the end of the year. But even before then, I'll be in touch just so that we have this conversation settled. Thank you very much for your time, and God bless to everyone who was able to join the call. I want to do some mini shout out to some of the guys who stayed from the beginning to the end. Eben, I see you. Thank you for staying. Ebenezer of Doja, you've always been a part of this session, Umbrella Saturday. Michael, I want to say thank you to you as well. You've been in and out. You've always been there as well. And Mr. Shola, thank you very much for joining the call. I know you joined a bit late. It would have been nice if you had the conversation, but I want to say thank you for being there as well. And some other people who joined the call. I know when we started,
I joined earlier, dropped out, came back in. So I heard some of the conversation. When Esther was speaking, I was here.
All right, thank you very much, Mr. Shola. I really much appreciate you. The recording would be available online for those who want to just go back and listen to it. Now I'm really very much interested in the Morocco market. Just what we can do to have the connected Africa. Like you spoke about that. I think that's my takeout in 2026. There must be a connected Africa. Africa must fund its own, from the government all to the private entities. We must fund ourselves, and I think that's the connected Africa that I see from the conversations that you've had. Beyond that, I think that, again, language for me, I think that we can navigate it in Africa. We just need to have the right mindsets, because, again, whatever you're going to review is similar to what we're going to review. The difference is the language. And I think that that's not a lot of barrier that we cannot navigate. Thank you very much for joining the call, and do have a lovely day. Bye.
Thank you. Bye, everyone.